Hey Tim,
Hey, Shay.
if someone was to fix part of their loan, does that mean that they then have two loans and two sets of repayments, or how does this work?
Yeah, it's absolutely right. If you want to fix part of your loan but not all of the loan, then that means you need to split it into two loans. In fact, if you want to do two different things at all, if you want part of it to be interest only or part of it to be principal and interest, any two different things, then yeah, they need to be completely separate loans. So if you've got a $200,000 loan and you want to fix half of it, then you need to split it into two $100,000 loans so that you can make one of them fixed and the other one variable. If the repayments on the $200,000 of lending is X, and then you split it into two, the repayment on the first one and the repayment on the second one will still add up to X, except that maybe the rates are a bit different. It might change a little bit, but it's not any different to just adding the two things together. But in your online banking, you'll see the fixed loan account and the variable loan account as two completely different entities.
Cool. Is this a strategy you would recommend to take advantage of the current market?
It can be, but I would say it's much more complicated than that to figure out what the right solution is, and whether you should be fixed or variable is only a small part of that. So yeah, that needs to form part of a much bigger discussion about what you're trying to achieve over what time frame, and all the restrictions that come with fixing as well, which might get in the way of it otherwise being a good idea.
Thanks so much.
No worries.